Sure. So I would say that, first of all, our expectation at the start of the year was that we may not have got to this level where $250 billion worth of U.S.
I just realised I just quoted your boss, sorry.
Yeah, so I have to, I have to agree, obviously. No.
I wasn't even thinking that, yes, of course. Yeah.
But no, broadly speaking, look, I think this is a tricky one because we're already seeing companies in the past 2 weeks of earnings reports state that increased input costs due to the tariffs are going to be eating into both their earnings or their ability to expand margins. And simply just are not a conducive condition for them to increase shareholder returns. So we've seen that from specific companies saying that, and if that voice becomes loud enough in Washington in terms of the business lobby, or just enough that Washington sees that the stock markets are so nervous about this, then perhaps that talks down, in a sense, the internal discussions of increasing the tariff amount. That requires, though, the paying attention to those elements.
I want you to realise I'm not going to ask every question quoting one of your colleagues today, by the way. It just feels like that at this moment in time. Richard, what do you think?
I think that ultimately this is going to get resolved. Now, that sounds like a brave thing to say, but the consequences of trade wars are pretty catastrophic and they're pretty imminent. And they show up in the economic welfare of very large numbers of people in both of these economies. So I don't know when and by what process this gets resolved. But at some stage, there's going to be massive.
Have you just paraphrased blind faith?
No, I think I've paraphrased a view that it's in the mutual interests of two consummate politicians to come to some sort of agreement.
So are you surprised then that it's gone this far?
Given the political background in the US, no. But we are where we are. But I think that what are we seeing at the moment? I think we are seeing some of the stress in equity markets are trade war related. I think it's a much broader issue than that. I think we're seeing a lot of concerns on the part of businesses who are finding it hard to run as efficiently as they did previously. And I don't think we're at the stage where a lot of this shows up at the aggregate level. But if it starts doing that, the incentive to come to an agreement when, if you're the US administration, they were the ones who ramped this up, and if what's coming through are clear costs rather than clear benefits, then that's a problem.
So can I ask you then, if you said that some of the volatility and some of what you've seen in the noise in markets is trade, but not all of it, what happens if trade is sold? Because I think there's a feeling that suddenly animal spirits start to come back. You might see a change in commentary from some of the corporates. But if it's not just trade that's caused the issues and perhaps it's the Fed, where's the bounce back? Do you think the Fed's going to limit some of the bounce back because it still has its pathway for 3 rate hikes in 2019?
Yeah, I think you're right to say, look, there's a lot more going on than just trade wars. I'd agree with that. And if they were to come out with an agreement later on this month, I think it would be good in a mild way for equity markets. But I think the challenge for equity markets at the moment is that there's a lot of what I call late cycle thinking going on. So I'll summarise it briefly. This has been a very long cycle. Every day that goes past, we're getting close to the end of the cycle. And there are lots of things which are happening at the margin which are making it a harder environment. So growth appears to be slowing and inflation's picking up a bit and margins may be coming in. So even without the trade wars, I think that these concerns are on the table.
I'm painfully aware that I'm actually going to lose both of you at 8 o'clock. I thought I had you for another hour, Nandini, as well. So I do want to get some calls as well. Remain regionally diversified in equities. Just want to fill that out for us a little bit.
Yes, so we're talking about late cycle. It's obviously focused on the US, who has had the longest expansion, the highest growth numbers currently. It would seem that perhaps you get out of US equities in a time when the US stock market is the one that's feeling the pain or the recessionary forces, but actually in previous drawdowns, the US stock market outperforms others, Japan, Europe, and EM. So we just are talking to clients about not running away from the US despite the fact that US is the latest in the cycle.
Yeah.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.